Welcome. My name's Chris Gosling from Australian Fund Monitors. Today I'm talking to Alan Pullen from Magellan Investment Partners. Alan, welcome.
Thanks for having me.
You've been with Magellan for a long time. Give us a little bit of your history.
So more than 13 years now. So I joined Magellan, realizing that as an investor, I really, my natural style was to invest in these high quality companies was exactly what Magellan is known for. And also with valuation discipline. So I was previously with a more value oriented manager. And that's absolutely essential when picking stocks, but also that quality element. So Magellan really brought them together and looking at the best quality companies around the world. So it's a dream job for me.
Okay, good. So the Magellan Global Opportunities Fund, which you are the PM for, tell us about that and what its philosophy is and where and how it invests.
Yeah, no, it's got a really strong philosophy. And I'm glad you actually asked me about that because I think philosophy is so important in keeping you on track on what you're trying to achieve as an investor. And we've got a really clear philosophy that's really proven to outperform over time. And that is around quality. I mentioned that already. Quality companies are proven to outperform over the long term. And we believe will continue to outperform the market going forward because the market tends to think short term. And those quality compounds compound over the long term. So we spend a lot of time thinking about quality companies. We're very strict in what that means in terms of economic moats and competitive advantages. We spend a lot of research delving out those quality companies from around the world. Two, I would say, is intrinsic value. And again, even the best quality company can be a bad investment if you overpay for it. So, making sure that we're not overpaying for those high quality companies. That doesn't mean a low PE or a headline valuation. That means assessing the intrinsic value of the companies and making sure you buy those companies at a discount to what you believe that intrinsic value is. So we're very strict around that discipline. And I'd say the third key element of philosophy is that long-term nature of investing. We're not traders trying to buy a stock, wait for it to go up a bit, sell it, do it again. We really think of ourselves as investors in the underlying business. So we're happy to own for 3, 5, 10 years if we need to. And that really changes your perspective and how you think about investing, about the underlying quality of the company and the business rather than numbers on a screen.
So at the current time, there's a bit of debate. In fact, more than a bit of debate, there's a lot of debate about whether the market is overpriced. There's amazing valuations. Obviously, AI and the tech boom, it is still current, getting a bit wobbly or frothy.
Mm-hmm.
How do you avoid that, or do you want to avoid it? Are you a believer that it's going to go on forever?
Well, nothing goes on forever, and this certainly won't either. But I'd say we're not in the doom and gloom camp. So, we go back to that underlying investment philosophy and the quality of the companies, many of which are positively exposed to Gen AI, which is real. It's a real technology. It's very useful today. The question is all the valuation around it justified? Now, we can see some companies where it appears justified. We think about companies like Microsoft, like Amazon, very broad exposure to Gen AI through their public cloud platforms, growing very strongly and not overvalued. Their valuations are very reasonable in those contexts and even in absolute terms. And then you've got other companies like Tesla and Palantir where, yes, it does seem like speculative excess has gotten a bit out of whack and things are a bit out of whack there. So I think it's really important in these kind of markets to have that strong investment philosophy, to not get caught up in the speculative areas and to say kind of centered on intrinsic value and quality.
Do you end up with a problem that you're too selective in one particular area, or are you broad-based?
Well, we make a deliberate effort to be relatively broad-based. So, this is not designed to, deliver kind of hit or miss returns. We're really looking to deliver kind of index plus performance in this type of portfolio. And that means we're always going to have selection across the portfolio. We've got defensive stocks. We've got more return-seeking stocks, tech stocks, but we've also got healthcare, consumer staples. We've got some financials in there, select financials. So we always have a very broad range of stocks in there, make sure we've got some good diversification. We will absolutely lean into those areas of the market where we're getting a better combination of quality and intrinsic value, but we're always going to have a broad array of exposures.
So US equities or global equities have significantly outperformed the large cap area in Australia but when we look at managed funds. Do you see that being able to continue?
Look, probably. Now, I would say that. I mean,
dangerous question, isn't it?
Dangerous question. Markets do mean revert for a bit, but when you look at the drivers of returns, the drivers have been fundamental in nature. So this hasn't simply been PEs expanding like the dot-com bubble, right? People are thinking the dot-com bubble. There's been a little bit of that, but there's also been enormous underlying revenue growth, earnings growth, free cash flow growth from these big tech stocks, which, excuse me, they can expand globally. They've got incredible business, wide economic moats, great cash flows. So most of that outperformance over it's been going on for decade plus, right? Most of that outperformance has been driven by fundamentals. So that means it's more sustainable going forward. Does it mean international equities will always outperform Australian equities? No. Australian equities have their time in the sun. But just given the opportunities available globally, more likely than not, they'll outperform over the term.
Let's just leave, if we can, the tech sector alone. I mean, it's difficult to avoid the tech sector because it's so dominant in the media, apart from anything else, and in pricing. Mm-hmm. Where else do you invest at the current time?
Yeah, no, it's a really good question, because indeed, when something's the flavour of the month and it's all in the news, it can suck a lot of money into the market. It can make valuations there pretty expensive, but also open up valuation opportunities in other parts of the market. And so at the moment, we are starting to lean in to some of those other parts of the market. Consumer staples kind of being left behind in this environment, for example. More recently, we've seen healthcare start to perform well, but actually, it was also had some really strong opportunities just a few months ago, and there's still really good opportunities in that sector. Financials as well. Infrastructure has some good opportunities as well. So, plenty of opportunities outside the tech sector globally.
And we've talked very much sort of US focus or North American focus. Are you invested elsewhere globally, or is it very US centric?
Well, we can go anywhere globally, and we do. So we've got broad exposure to Europe, some exposure to Asia, for example. But typically developed markets, because we are looking for those very high quality companies. Typically find those more in developed markets. But the US does happen to have a lot of the world's great companies happen to be listed there.
Sure.
Now, they are global in nature. When you think about Coca-Cola, less than half its business is in the US, but it's listed in the US. And the tech giants as well, of course, are global businesses. So we still have more than half the portfolio by listing in the US, but it's really a global portfolio when you cut through into revenues.
Sure. Without trying to focus on the negative, if there was a glitch in the market, mm-hmm. or if there is to be a glitch in the market, you did say that markets don't go up forever.
Yeah.
Can you try and pick what might tip it over? Is it just valuations, or is it interest rates that as it has been in the past, although they look as if they're probably going to come down rather than up in the US? So what's the catalyst for a change in this market, which has been so strong over the past 1, 2, 3 years?
Yeah, no, good question. Markets don't go up forever, so they absolutely will come down at some point. And just given where aggregate market valuations are today, if we do get that trigger, it could be quite a significant pull down. So investors certainly need to be thinking about defense, and we certainly are within the portfolio. As to what could actually trigger that, well, it's hard to say. Normally, you do need some sort of trigger to get this reversal. It's not normally just collapsing under its own weight, but it does happen. Things get too bad. We don't think that we're there yet. So what are we watching closely? US economic growth. We've certainly seen some weakness in the US labor market. We've seen some weakness in the low-end US consumer from our companies. So we're monitoring that pretty closely. Nothing to suggest that's imminent, but an area of concern. I'm kind of with you in terms of interest rates. They look like they're coming down at the moment. Certainly the Fed have indicated that. With tariffs, we could see some risk to inflation, but with that labor market weakness, Fed will probably look through it. And of course, we've got Trump is out there, so geopolitical
Trump's
concerns.
out there.
Yeah, he is out there. He's somewhat unpredictable. So, geopolitics or something like that could be a potential trigger or as well. So we're not seeing anything, imminent, but if something does happen to happen, and there's always black swans events as well, watch for the downside. It could be significant.
Sure. Alan, been really interesting talking to you. Good luck with the fund. We'll follow it closely as we do on Fund Nonsense and look forward to catching up with you again soon.
Yeah, thank you. It's great to chat.
Thank you. That's it from Alan Pullen from Magellan. Thank you.